Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
Welcome back. Today we are going to be tackling question four response from the CXC Principles of Accounts January 2025 past paper, which focuses on inventory valuation, most commonly called stock valuation, and this is under the perpetual system. Now, if you're preparing for your exam, this is a perfect lesson to help you master this topic. But before we get into working the question, let's break it down. Perpetual inventory valuation is an accounting method that continuously updates inventory records in real time as transactions occur. This system tracks inventory purchases, sales, and adjustments instantly, ensuring that businesses always have an up-to-date record of stock levels and the cost of goods sold. Now let's get into the question. But remember, before you start working, read your question first. And guess what, too? I want you to grab your past paper, get your calculator, get your writing resources, get your people, and let's get started. So the question read, Ray's appliances shop sells small kitchen appliances, including air fryers. He uses the AVCO method, which stands for the average cost method for inventory control and valuation of the air fryers. Part AI, identify one other method of inventory control and valuation that Ray could have used. So remember, Ray uses the average cost method. So what you're asked to do is to state one other method. And there are two other methods. And I look at one first, which is the FIFO, which stands for first in, first out. And then part two of this question asks to state briefly how the method identified in AI works. So because we have mentioned FIFO earlier, what we're doing for this part is to state how the FIFO method, which is the first in, first out method, works. Now, the FIFO method assumes that the first set of inventory items bought are sold first. So you made purchases on Monday, you made purchases Tuesday, you made purchases Wednesday. You are now making a sale. If it is that you are using the first in, first out method, the items that you would grab and sell out of that, maybe off the shelf or from the warehouse, wherever it is stored, you would grab those that came in the business first, which have been Monday's purchases. If it is that you need more, then you would move into Tuesday's purchases, etc. So remember, first in, first out assumes that the first set of inventory items that came into the business are the first to be sold. Ending inventory is therefore valued at the cost of the most recent purchases, meaning your closing stock is valued at the most recent price that you would have paid to get those stock. Okay, so that was the first in, first out. Now, you could have used as your response last in, first out, and we're going to look at that method. So for part AI, last in, first out, abbreviation LIFO. And to state how this method works, which is for part two, based on if it is that you would have used last in, first out, it basically assumes that the last set of inventory items bought are sold first. So it is the reverse of the first in, first out. Ending inventory is therefore valued at the cost of the earliest purchases. So remember earlier, I would have mentioned that purchases were made Monday, Tuesday, Wednesday. No, because you're using the last in, first out, the goods that came in Wednesday would have been sold first. Then if you need more, then you go to Tuesdays, etc. Now, when you're valuing whatever is left, bear in mind that the cost of those ending inventory, your closing stock, would be valued at the price of those goods that would have been purchased on Monday, the earliest purchases in the business. And if it is that there were any that remains on for Tuesday's purchases, then of course that would form a part of the ending inventory cost. And also, I would have been mentioning so far that we use the cost of the earliest or the cost of the latest. Now, bear in mind that when you're valuing closing stock, this is done at cost price. So on your piece of paper that you have in front of you now, just make a note of it. It's very important. Highlight it as well, because when you're valuing your closing stock, this must be done at cost price, meaning when you're doing your stock card, in determining what is the value of your closing stock, ignore the selling price. Let's move into part B of this question. During the month of December 2024, the following information is available for the movement of air fryers. We have date, particulars, which basically stands for details, number of units, and we have the cost price. Now, if you look at the details in this table, you're seeing December 1st, balance on hand, 502 at a cost price of 200. Balance on hand there means that this is your ending inventory coming from the last period, which now becomes your opening inventory at the beginning of this period. There were purchases in the month of December. There was also sales in the month of December. But if you notice under the cost price column, you're not seeing any price beside your sales. But bear in mind that when you're doing your inventory valuation, when you're valuing your stock, I'm going to say it again, this is done at cost price. So not having the price at which the items were sold at will not deter you from completing your response, from identifying or calculating your ending inventory cost, because of course you are ignoring the selling price when you're doing your valuation of your ending inventory. Now, what you're asked to do is to complete the form provided on page 16 to record the inventory valuation of air fryers for the month of December 2024 using the average cost method. And bear in mind that this is bold. Round off all calculations the nearest dollar, and this is very important. Now remember, you're doing the average cost method, and you're also told that you need to use the form provided on page 16, meaning the form that you're given in exam, that is what you're required to use, because they are testing you to see how well you are able to use, you're able to apply the concept using that particular form that is given. So let's move into that part. So this is the form that is given. At the top, you're seeing average cost inventory calculations. Remember, you are applying the concept of average cost. You have a column for date, cost of inventory in, and for this column, you're going to be looking at the items that were purchased. So this column is used for your purchases. Cost of inventory out, this column is used for those items that were sold. And the next column is looking at unsold inventory. At the end of that particular period, that day, after the transaction, what is the number of units you have left on hand? That is what this column is asking for. Then your calculations of average cost. What is the average cost of the units that you now have in the business at cost price? That is what this column is asking for. This final column is looking at the value of inventory on hand. What is the cost price of the number of units that you have now in the business? That is what it's asking for. So in completing this, definitely, of course, we're going to be tackling between the question and the response form. So ensure that you pay close attention to what is happening in this lesson. So let's get straight into completing the form, but we have to go back to the question to get our details. And we're doing this per date of the transaction. So we're going to be looking at December 1st, and it stated balance on hand. Remember earlier I said balance on hand is basically your balance brought down, your opening balance coming from the previous period. So this is your closing coming from the previous period becomes your opening. And the number of units in hand are 502, and the cost price for each of those is $200. So let's record that in our stock card. So our date, very important, which is December 1st, 2024. In our cost of inventory in, I'm going to be recording our balance brought down, which because it is the carry down coming from the previous period, it becomes balance brought down. So we're making note of that. Now, the number of unsold inventory coming from the last period, there is 502. The cost per inventory is $200. And the value of inventory on hand, to calculate that, it is going to be the 502 multiplied by the cost per unit, which is 200. And this gives us an opening inventory of $100,400 worth of goods. So what it's saying is that the 502 units that we have on hand at the beginning of the period at a cost price of $200 each, the total value of that is $100,400. And we're going to move into the next date, which is December 6th. On December 6th, we're seeing that there was a purchases of 125 units at $230 each. So it is saying that during the period for December 6th, the business bought 125 more air fryers and paid a cost of $230 each. Let's record that in our stock card. We need to update our stock card with that. So the date is December 6th. Under cost of inventory in, because it is purchases, we're going to note 125 at $230 each. And once you record that, you move into your unsold inventory. To get your unsold inventory, remember, we are not going to ignore the fact that there was 502 items already in the business, and now there was a purchase of 125 more. So it therefore means that this 502 now increased by the 125. So we're going to add 502 plus 125, and that gives us a total units of 627 units now on hand. Now, in terms of the next two columns, once you purchase, your average cost per unit will change. But before we calculate this, we need to determine what is the value of inventory we have on hand. At the end of December 1st, remember, in total, there was a value of $100,400 worth of inventory. Now the business spent some more cash in purchasing air fryers, and we need to update this. So we're going to determine the cost of the 125, which is 125 times 230, and that gives us a value of 28,750. We now add that to the previous cost of inventory in the business, and that gives us a total now of 129,150. So again, you're adding the value that the business would have spent on this purchase to what was in the business previously, which would have been the 100,400, and that gives us a total value of the stock that is now in the business at cost price of $129,150. Now, we need to determine what is the average cost per unit of goods in the business now, which is the air fryer. To determine that, you are going to pick up your value of inventory, pick up the value of inventory on hand, and you're going to divide that by the number of unsold inventory. So remember, to get your calculation of average cost, it is the value of inventory on hand divided by the unsold inventory. And I need to point out to you that the only time the average cost per unit changes is when you would have made additional purchases. So once there was an additional purchase made, then you have to ensure that you divide the value of inventory on hand by the number of unsold inventory. Good. So let's do that. We're going to divide the 129,150 by the number of units of 627, and that gives us an average cost per unit of $206. Good. So now that that is done, we're going to move on to the next date, which is December 13th. And we noticed that on the 13th, there were sales of 257 air fryers. We're going to update our cost card with that. So that is December 13th. And because the units were sold, we're going to be using the column cost of inventory out, which is 257 at still cost price. Remember, we're not using any selling price when we're doing our stock card. So before the 13th, there were 627 units on hand, and that is at a cost price per unit of $206. So what you're noting in this column on the 13th, on the cost of inventory out, is that you would have sold 257 units from the batch of goods that cost the business $206 on average per unit. Now, if it is that you had 627 previously, and now you're selling 257, that is going to reduce the number of units that you have on hand. So in updating our unsold inventory, what amount of units the business now have in the business that can be sold, we're going to subtract the 257 from the 627. So that is 627 minus 257, and that gives us unsold inventory of 370 units. So this is saying in the business now, Ray has a total of 370 air fryers that are available for sale, given the fact that Ray would have sold 257 earlier. Now, remember, the next thing that you're going to do is to update your value of inventory and also the average cost per unit. But I want you to note, remember that thing that you would have highlighted? Remember that The only time you change your average cost per unit is when you make a purchase. So in this case, because we have sold, the cost per unit remains at $606 each. Now, to get your value of inventory on hand, if you have 370 units, each of them costs $206. What is the value of your inventory? And yes, we're going to multiply the 370 by the cost per unit, and that will give us $76,220. So again, the 370, which is the number of units in the business now multiplied by the cost price, that give us 76,220. So at the end of December 13th, the closing stock of units on hand is 76,220. Let's move into the next transaction. Now, on the 19th, we are noting that Ray purchased an additional 175 air fryers and paid $245 each because the cost price column is saying $245. With that said, we need to update our stock card after that transaction. So on the 19th of December, because there was a purchase, we're going to use cost of inventory in column. And we note that 175 units were purchased at a cost price of $245 each. Now, before the 19th, which is at the end of the 13th, there were 370 units on hand. Now that Ray purchased 175 more units, it's now going to increase this 370. So we're going to add the 370 and the 175 that was just purchased to give us a total inventory on hand. Now, unsold inventory, what Ray has in the business now that can be sold, of 545 units. Now, remember, you have to ensure that you update your average cost column and your value of inventory on hand. Because a purchase was made, the average cost per unit will change. So it therefore means that we need to determine what is our value of inventory on hand before we can determine the average cost per unit. Now to do this, you're going to multiply the 175 by 245, and then that value is then added to what was the previous value of 76,220. So the calculation is 76,220 plus 42,875, which is the value that we got when we multiply 175 by 245, meaning to get the 175 units, Ray spent $42,875 to get that. That is now added to the previous value of goods that were in the business at the end of the 13th of December, which is 76,220. And that now give us a total cost price for the units that we have on hand now, which is a 545 of $119,095. Now that we have our value of inventory on hand, we know the unsold units. We now are able to determine the average cost per unit. And remember, to get the average cost per unit, it is the value of inventory on hand divided by the number of unsold inventory. So let's do that calculation, and that gives us a value of $219 per unit. So now, at the end of December 19, we are seeing that Ray has a total air fryers in the business of 545, which with an average cost of $219 per unit, and at cost price, the ending inventory at the end of the 19th of December is $119,095. Let's move into the next transaction, and I hope that you are understanding well. The next transaction took place on the 23rd, and again, business is going well for Ray because Ray sold 322 items. 322 air fryers. So we're going to update the stock card after this transaction. So on the 23rd, and because items were sold, we're going to use cost of inventory out, and that is 322 at cost price, which is the value of the inventory that are in the business per unit of inventory in the business. At cost price, remember, we don't use selling price in our stock card. And at the end of the last transaction, we're seeing where the average cost per unit is $219. This is why we record the 322 items that were sold at the cost price of $219. That's where we get that $219 from. Now that you have sold 322, we need to update how much units of air fryers Ray now has in the business that can be sold. 545 minus the 322 sold leave Ray with 223 air fryers in the business. Our cost per unit remains because remember, we did not make any purchase. The only time it changes is when you make a purchase. So we're going to bring down this $219 per unit, average cost per unit. Now that we have done that, we can now determine what is the value of inventory on hand. Remember, to get your value of inventory on hand after a sale, you multiply the number of units on hand, which are your unsold unit, by the average cost per unit, and that is a 223 multiplied by 219, and that gives us a closing inventory at the end of December 23rd of 48,837. And we're going to move into the next transaction, which took place on the 29th. And again, business going well. Ray went ahead and purchased 200 more units and paid $206 per unit. So let's update our record with that. That was on the 29th because purchases were made. We're going to use cost of inventory in 200 units purchased, $206 per unit. And in this case, it now increased the number of units that Ray has on hand for the air fryer. It was 223. Now Ray purchased 200 more. How much units Ray now has on hand? Number of air fryers on hand, 223 plus 200, that gives us 423. Because Ray made a purchase, our average cost column will be updated. So we're going to leave this for the last thing to be filled in because we have to determine what is the value of inventory on hand. So previously, the inventory on hand was 48,837 at cost price. Now Ray spent some more money to get the 200 units. So the value of inventory on hand will be increased. So multiply this 200 by the 260, that gives us 52,000. We're going to add that 52,000 to the 48,837. And that gives us a closing inventory of 100,837. Now that we have the value of inventory on hand, remember, you need to determine what is the average cost per unit. And to get that, remember, it is value of inventory on hand divided by the number of unsold inventory. So let's complete that column. Let's go. It is a 100,837 divided by the number of units on hand, which is 423. And that gives us an average cost price of $238 per unit. And we're going to move into the last transaction. On December 30th, Ray sold a volume of 410 air fryers. Now we're going to update our record. So that is December 30th. Units sold, we're going to enter that on the cost of inventory out, which is 410. The cost price, remember we use the cost price, and the last price that we have under the average cost column was 238, which is saying that the 423 units that were in the business at the end of December 29, each of them cost $238. So the cost price when you're recording your inventory out on this day, the 30th of December, is 410 at $238 each. Ray had 423 units before this sale. Know that he sold 410. How many units Ray now has on hand of air fryer? That is the 423 minus the number sold of 410. Leave Ray with only 13 air fryer. Business doing well, yes. And the average cost per unit remain at 238 because remember, the only time it changes is when you make a purchase. And if Ray has 13 units on hand at a cost price of 238 per unit, what is the value of inventory on hand? That is 13 multiplied by 238, which gives us a closing inventory of $3,094. And that takes us to the end of part B. But once you would have completed your stock card, you need to write your statement below your response indicating that closing stock using average cost is the last figure coming from the value of inventory on hand, which is $3,094. So this is basically saying that closing inventory for the air fryer is $3,094. We're now looking at part C, where you're asked to calculate Ray's total cost for purchasing air fryers in the month of December 2024. And we're going to use this space to calculate the total cost for purchasing air fryers as required, but we have to go back to the question to pick up the details regarding the purchases. And that is December 6th. Purchases were made on that date, the 19th and the 29th, but we're going to focus on them individually. So on December 6th, purchases, 125 units of air fryers were purchased, and Ray paid $230 each. Let's add that to our workings, and that is December 6th, 125 units multiplied by $230 each, and Ray spent a value of $28,750 to purchase those. There were two other, and we're going to add those, but we have to get more details regarding those. On the 19th, 175 units were purchased at a cost price of $245 each. Let's put that in our workings. December 19th, 175 multiplied by $245, and Ray spent for this purchase $42,875. And there was one more, and we're going to pick up our details from the question. And that was the 29th, a total of 200 air fryers purchased, and the cost price per air fryer on that date is $206 each, and we're going to add that to our workings. December 29th, 200 multiplied by 260. For this purchase, Ray spent $52,000. Now that we have all three purchases from the question, we can now determine the total. So we add all three purchases together, and that gives us a total of $123,625 spent on air fryers for the period of December. And we're going to move into the next part of the question. And this part reads, Ray sells an air fryer at the price of $650. Calculate the total revenue from the sale of air fryers for the month of December 2024. All it's asking you to do is to calculate the sales revenue for air fryers for the month of December. And like we did for purchases, we have to do the calculation for the sales. So here we go. Total sales revenue of air fryers. And we have to go to the question. We have to go back to the question to get the details for the number of units sold. And this is a time when you would use the selling price. You would not use the selling price when you're preparing the stock card. You only use the selling price when you are determining the value of the sales. So let's go to the question and pick up the periods when sales were made, and that is December 13th, 23rd, and 30th. On the 13th, 257 units were sold. So we're going to record that in our workings. And that is December 13th. Remember, one unit was sold for $650. So it is 257 multiplied by 650. And that gives us a value for sales coming from that number of units sold on that day of $167,050. There were two more. We're going to pick up those. The 23rd, 322 units were sold. Let's put that in our workings. December 23rd, 322 at a selling price per unit of $650, and the value received from the sale of those units was $209,300. I know you're looking at another method in calculating it. I soon get to that one too. But in this case, I'm using this structure to show you first, because just in case the selling price is not the same, it is not fixed, then you will have to do the workings for each sales. So that is exactly what I'm doing so you can get the concept. Let's pick up the last sales that were made, and that is on the 30th. 410 units were sold. Let's add that to our workings. So that's December 30th, 410. The selling price remains at $650. And the total sales revenue from that sale on the 30th is $266,500. Now that we have all the sales, we can determine the total sales for December 2024 for air fryers. And that is $642,850. So the sales for the month of December is $642,850. So I look at this structure because just in case your selling price is not fixed for the period, you would have to do your calculations individually. Now I'm going to look at the easier part, which may be easier for some people. Some people may rather this, or you may rather the other part. So because the selling price is fixed, you could have used the alternative approach where you pick up the total number, you determine your total number of units sold, you multiply that by the selling price per unit, and that would give you your total sales revenue. So that is the total units sold multiplied by the selling price, and that would give you your number of units sold. So let's determine that using this structure, this concept, this method, and that is the 257 plus the 322 plus the 410. So it is 257 plus 322 plus 410. And then when you determine your total units sold, you multiply that by the $650 each. So the number of units sold were 989, and you multiply that by the selling price per air fryer of 650, and that gives you your total sales revenue of $642,850. So that is $642,850 for the sale of air fryers for the month of December. And that takes care of part D of the question. We have one last part to complete, and we're getting straight into that. I'm trusting that you're understanding thus far. And let us move into the other part of the question. And now, you're asked to prepare an income statement using the form provided below to show the gross income. When we say gross income, we're talking about the gross profit earned by Ray's Appliances Shop from the sale of air fryers for the month of December 2024. And they were generous to you people because they would have entered the title. If it is that the title is not entered, remember you need to put in the name of the business or the owner, whichever one is available. If you have both, use the name of the business. Put what you are preparing, which is income statement, and it is for the month ended December 31st, 2024. The first thing we're going to pick up is sales, because remember, to get your gross profit, also known as your gross income, it is simply your sales minus your cost of goods sold. So let's go. So we pick up our sales, and we have to go back to get the value of the sales, which is $642,850. And we're going to enter that. The next thing, we're going to pick up our cost of goods sold. We're going to calculate cost of goods sold because there wasn't any return inward. So we're going to move into subtracting our cost of sales, also known as cost of goods sold. To calculate that, we're going to pick up our opening stock. I mentioned that because that was a part of the question where there was an opening balance. Now, the opening balance is 502 multiplied by 200, and we are going to record that. So the opening stock, that was $100,400. The next thing that we're doing is add our purchases. Let's get back to our workings, determine our purchases figure, which was calculated earlier, which is the 123,625, and we're going to record that in our income statement. 123,625. Now we're going to add these two figures together, which is going to give us cost of goods available for sale, and that is $224,025. From our cost of goods available for sale, we are now going to subtract our closing stock. Now, our closing stock was determined in part B of the question, where we determined that closing stock using AVCO is $3,094. So we are gonna enter that in our response, and that is $3,094. This $3,094 is then subtracted from what we had available for sale, and that gives us our cost of goods sold, which is $220,931. So what we're seeing is that having taken out the value of goods that is not sold, we have $220,931 worth of goods that were sold at cost price. So all your workings that is done under the cost of sales, cost of goods sold, this is done at cost price. And that now, once you have your cost of goods sold, you can now determine your gross income, which is your gross profit. And that is $421,919 for your gross profit, which you were asked to show your gross income. Gross income, gross profit, the very same thing. Okay, remember to get your gross profit, also called gross income, it is your sales minus your cost of goods sold. And if you want to break it down back to your lower level, it is basically your selling price minus your cost price, give you your profit. So this is your profit before any expenses are paid. So coming from a question like this, inventory valuation, you can be asked to calculate gross profit, which we just did. Okay, and that takes us to the end of this lesson, where we focus on inventory valuation under the perpetual system.
Like, share, and don't forget to subscribe.